Greg. It's always great to have you on. You saw that survey
Thank you.
right there, a compilation of what respondents are telling us, what they're really worried about, right, going into the new year. What would you say is top of mind?
Well, of those three, it would be inflation. The the markets are adjusting to this life with COVID, so we're just going to be living with it. But the economy, when the Fed pulls back, excuse me, when the Fed pulls back, it's stimulus, and the economy has to run on its own. We're going to see more volatility, and that volatility is what's going to be a real challenge for investors, because we don't expect to see the types of returns in the equity market that we've seen over the last 2 years. We expect to see something that are going to be more muted in equity and fixed income returns, and fixed income is going to be challenged in a rising rate environment.
So inflation is your top concern. You think that will put a lid on how much stocks can run up next year? If that's the case, what shifts or changes are you making to your portfolio? How do you sort of still capture gains if the gains are going to be limited?
And so this is the challenge. This is really about expectations. So what we're investor expectations for returns. So we're still fully invested. We don't believe in trying to time the market. We're still in the market. However, we're shifting our equity portfolios. We're making some shifts in the technology sector. We still love these business models that have recurring revenue, and that includes Microsoft, Google, and Facebook, that have just these sustainable recurring revenues. So that's still a big part of the portfolio. We've increased the consumer staples section of the portfolio. We've got Costco and Walmart. That's still a big part of that portfolio. Financials we're neutral on.
Yeah.
So we're making changes in the portfolio. We're still fully invested, but the expectations really are mid-single digits on equities for next year.
We're showing a chart of Costco. I didn't realize it's up 50% this year, really a beneficiary over the last 2 years. Here's a broader question here for you, Greg. As you compile your portfolio for the next year, you put a certain percentage in equities, bonds, and then cash. Are you upping the amount you're putting in cash?
Yeah, and that's hard for us to do. We're normally we're fully invested. We're less than 5%. We'll take it up to 10%, and it's transitional. And the reason is when the Fed pulls back its stimulus and the market has to just work on its own, we assume we don't have government intervention in the markets, which since 2008 that's what we've lived with. So if the market flies on its own, we'll see more volatility. Then things like geopolitical risk and what China's doing, what Russia's doing, they start to matter. And that will have an impact on sentiment. So that's a big part of it. The growth in the private credit sector is a problem.
Sure.
That's a worry for us that we're looking at.